Dear clients, I'm Richard, Phillip CFD dealer. In this week's commentary, we will recap on market actions in the opening weeks of 2014 amid an impending shift in market psychology as we transit into post-QE era. In addition, I'd like to share some cross-market signals that could help equity market participants navigate a more wobbly environment as financial markets contemplate the sustainability of global growth momentum. In my last commentary, I noted that the S&P continues to skew new heights on the back of global growth optimism. In fact, the S&P has gone 27 months without a drop of 10% or more. However, I also cautioned that the US economy, which is already in its 5th consecutive year of growth, is not a young cycle. I believe that as we gradually exceed the stimulative QE environment, market psychology will be adjusting back to the good old economics logic that reads bad news is bad news, and bury the bad news is good news distortion of the QE paradigm. In other words, investors who want to stay in the game needs to get off the fence and decide whether growth momentum will accelerate or cool off without stimulus. Despite touching an all-time high last week, the S&P is essentially a sideways trending market in the first 3 weeks of 2014, as disappointment over weaker than to inline estimated earnings at companies from Citigroup to General Electric offsets an improving outlook for the global economy. MSCI Asia Pacific Index also finished last week within 2 points of its closing levels for 2013, as investors weighed signs of a stronger global economy against concern about equity valuations. In terms of cross-market actions, it is noteworthy to highlight that in the immediate aftermath of the first growth scare of 2014, manifested in a much worse than expected December non-farm payrolls print, investors' reflex seems to be reaching out for hedges against potential downside risk. This is reflected in the more pronounced buying actions in safe havens such as US Treasury and gold relative to deep buying in the equity and FX space. Now, the question is, which cross-market signals should equity investors pay attention to at this juncture, given that S&P is hovering near its all-time high and its PE valuation is near the loftiest levels since 2009. As we are making our transit into post-QE era, I feel that the current cross-market actions with equity, FX and bond yield capped at recent highs, whereas gold found support at recent lows, are sounding somewhat out of tune with the self-sustaining global growth rhetoric of accelerating growth momentum and normalizing yield. As such, I've selected 3 cross-market signals, namely Euro-US dollar in the FX space, 10-year US Treasury yield, and gold that should help to corroborate the continuation of a rising equity market, or conversely, to warn of a potential equity correction. In my opinion, a rising Euro-US dollar is a decent proxy for global growth momentum, as consensus optimism is increasing for the Eurozone, on the premise that the largest economic bloc in the world is on the mend. A successful transition towards post-QE economic self-sustainability should also be reflected via a normalizing, rising 10-year US Treasury yield. As for gold, in the post-QE and yet tame inflation expectation environment, it is tougher to justify its existence in a portfolio, except for secondary considerations of asset diversifications and safe haven needs. And did these cross-market signals flash amber lights in prior episodes of market paradigm shifts that resulted in equity market corrections? Well, while macro conditions have changed, and these cross-market signals are by no means a crystal ball, they did respond in discernible manner that corroborate with equity market corrections during the past 2 episodes of QE1 and QE2 exits. For instance, the Euro-US dollar rally stalled and was responsive to the downside as growth and political uncertainty sets in, while the 10-year US Treasury yield also failed to continue its rally, as investors could not resist its safe allure. Interestingly, gold starts to trend higher, against conventional wisdom that an exit for currency debasement should be a clear negative for the precious metal. Hence, if history is indeed our guide, then I think equity investors should keep an eye on these cross-market signals. The handles to look out for, namely, are Euro US dollar at 1.38, 10 years US Treasury yields at 3%, and gold at 1,200 US dollar. Should the self-sustaining global rhetoric pans out steadily, we ought to see Euro US dollar punching through 1.38 to the upside, bond yield rising above 3%, and the precious metal breaking down the 1,200 US dollar floor convincingly. On the other hand, if cross markets do not clear these levels, it signals skepticism that the smooth sailing days of 2013 gets extended into 2014, and hence be forewarned of an increasing risk of equity-based correction. Clients may consider using Phillip CFD to trade equities and indexes across markets to capitalize on trading opportunities in both rising and falling markets. In addition, you may also trade based on different strategies using many more benchmarks which are available with Phillip ETFs. Look forward to Monday's weekly market watch, where the topic is posted on PhillipCapital's Facebook. We want to hear from you. Any questions, any comments on Monday's topic? Please drop them via Facebook and Twitter #TalkToPhillip. Thank you for watching this week's Market Watch. I'm Richard from Phillip CFD. Tune in next week for more market video. Thank you.